Hello ladies and gentlemen, and anything in between. Today's video will be about income statement and statement of financial position questions with adjustment. This is the second video I've made on this. If you go and click on my channel, you'll be able to watch the first part. But anyways, let's get into the question straight away. Alright, so this is the first question. Harry Maguire sells online defending courses. The following balances have been extracted from the books of account at 31st December 2009. Alright, so we've been given the balances down below, and then below that it says additional information. These are the adjustments that we will be making. However, before we do that, there's a four-step rule that we should always follow. To be honest, you don't have to follow it, but it makes it a lot more easier. So the first thing I think you should do is draw your layouts. Also, if you want to have a go at the question before I go through it, you can pause the video and go through it yourself. But anyways, these are the layouts that I've made for them. So at the top we have income statement 4. It says business name. Our business name is Harry Maguire. So we put Harry Maguire at the business name. And then for the date we put 31st December 2009. We do that for both the income statement and the statement of financial position. Okay, now we've done that. Our second step says deal with any year-end adjustment. So the year-end adjustments will be the additional information. So the first one says stock at 31st of December 2009 was valued at 22,400. What this means basically is that is the closing inventory. So closing inventory goes in both the income statement and statement of financial position. So what I like to do is put this information just right next to the balances. So when I transfer the figures in later on, I don't forget about it. So I just write it right there so I don't forget about it. Second adjustment. It says the motor vehicle is to be depreciated using the straight line method over 5 years. The estimated value of the motor vehicle at the end of the 5th year is 3,600. First of all, we will have to know what the straight line method is. The straight line method of depreciation is cost minus residual value times percentage or divided by years. In this case, we will have to divide it by years because we've been given the year. And our residual value is 3,600. So what we do is we look at the balances. We have our cost, which is 18,600. We do 18,600 minus the residual value, which is 3,600 over, meaning divided by 5 years. And that should give you 3,000. So this 3,000 is depreciation expense. This depreciation expense goes into the income statement. However, you have to add 3,000 to the provision for depreciation as well, which goes in the statement of financial position. So we do 9,000 plus 3,000 equals 12,000. So I'd like to just put a plus 3,000 next to the provision for depreciation balance on the screen, so I don't forget about it when I transfer it into my figures. Third adjustment, rent unpaid at 31st December 2009 amounted to £80. So what this means basically is we haven't paid £80 of rent. That means we have an accrual expense. Accrual expenses go in the statement of financial position. So first of all, we put £80 next to our balances and we label it as accrual expenses so we don't forget about it. And then what we also have to do is add the £80 into our rent balance. As we can see, rent and rates have been combined, so we just add £80 to rent and rates. This is because when it comes to making income statement and statement of financial positions, you should always put the amount that you should have paid, not what you have paid. Fourth adjustment, annual rates are 720. At 31st December 2009, 3 months have been paid in advance. So this is just the opposite of the third adjustment. We've paid an extra 3 months. So as I said before, you should only include amounts that you should have paid, not what you have paid. So what we do first of all is 720 divided by 12 to get a month of rates, and then we times it by 3 to see what our prepaid expense are, what we've paid in advance. So we get £180. So £180 is prepaid expense. We put the next to the balances and we label as prepaid expense so we don't forget about it. And then we also subtract 180 from rent and rates because we only include amounts that we should have paid. And this gives us 8,340. Alright, so the third step is transfer your figures. So now I'll be transferring all my figures and I won't be speaking through it because it doesn't really need me speaking through it. I'll just fast pace it. Alright, so now we are at the last step where we have to calculate all our figures. So first we start with our income statement. So we do revenue minus sales return, which gives us our total sales of 95,790. Then we go into cost of sales, which is opening inventory plus purchases minus purchase returns plus carriage inwards minus closing inventory, which gives us our total cost of sales of 56,510. And then to work out gross profit, we do our total sales minus our total cost of sales, which equals 39,280. Then we have our income. Discount received is our only income, so we write 1,220. And then expenses. We have discount allowed, general expenses, rent and rates, telephone expenses, depreciation expenses. And this gives us a total of 18,970. So now to work out the profit of the year, we do our gross profit plus other income minus total expenses, and this gives us 21,530. Okay, so now we have the profit of the year. We have to transfer that profit of the year into our statement of financial position in the finance by section. So we write 21,530 at the profit of the year. Alright, so let's calculate it from top to bottom. So first we have non-current assets. Our non-current assets is motor van, which is 6,600. Alright, so now we have our current assets, which is bank, closing inventory, and prepaid expenses, which total up to 24,700. Then we have our current liabilities, which is trade creditors and accrual expenses. For the ones that don't know what trade creditors are basically suppliers we've bought from on credit terms, buy now, pay later, which add up to 5,770. And then we do our total current assets minus total current liabilities to give us net current assets, which is 18,930. And then we don't have any non-current liabilities, so we just leave it like that. And then to work out our net assets, we do non-current assets plus our net current assets minus any non-current liabilities. However, we don't have any, so that gives us a balance of 25,530. So now we go into our finance by section of the statement of financial position. Our capital is 20,650. We don't have any capital introduced. Our drawings is 16,650. Profit of the year 21,530. So we do capital minus drawings plus profit of the year, which gives us 25,530. And the way we know this is correct is because our net assets is the same as our closing capital, both 25,530. So that's it for this question. That's the income statement and the statement of financial position done. Alright, so this is our second question. Richard Furley sells sports equipment. The following balances have been extracted from his books of account at 31st March 2000 and whatever, it doesn't matter. And then these are all the balances down below. And then just right below that it says additional information. That's the adjustments that we will be making. So once again, we follow the 4-step rule. The first step is to draw our layouts. I've drawn my layouts. The only thing I have to do right now is put the business name and the date. The business name is Richard Fairley and the date is the 31st of March 2003, 2013, it doesn't matter. Okay, so now we've done our first step, we must do our second step, which is to deal with any year adjustments. So as we can see, we've been given 6 adjustments. The first one says inventory at 31st March 2000 and let's say 3 were valued at 26,450. What this means is that's the closing inventory, because if you read the following line on the top, it says the following balances have been extracted from his books of account at 31st of March. So that's the end inventory. So once again, so I don't forget, I just put it next to my balances. So when I transfer my figures later on, I don't forget. Second adjustment. It says annual rent of 10,360 has been paid for the year ending 30th September 2003. So our year end is 31st of March and we've paid up to 30th of September 2003. That means we've prepaid 6 months, because if you count it, April, May, June, July, August, September, that's 6 months. As I said before, you only include amounts that you should have paid, not what you have paid. So 6 months is a prepaid expense. To work out, you do the 10,360 divided by 12 times it by 6 to get 6 months. And that 6 months is 5,180. And then you subtract 5,180 from rent and rates. And this gives you 13,210. So once again, I put the balances next to our already existing balances. So when I transfer our figures, I don't forget. Alright, the third adjustment says the shop fittings are to be depreciated using the straight line method over 5 years. The estimated residual value of the shop fittings at the end of the 5th year is 1,800. Alright, so what we do again, we remind ourselves of the straight line method of depreciation. The first way of doing it is cost minus residual value times percentage. The second way is cost minus residual value divided by years. In this case, we're going to be dividing it by years. So we go look at the cost of the shop fittings is 15,200. We do 15,200 minus 1,800 divided by 5 years. And that gives us 2,680. Alright, so we add 2,680 to the provision for depreciation, and then 2,680 separately to depreciation expense. And we put the balances on the screen again. Fourth adjustment. On 31st March 2003, Richard Furley transferred 2,500 from his personal savings into the business's bank account. The transaction has yet to be accounted for. So when we invest money into the business, that's called capital. So 2,500 is capital introduced because it was during the year, and it was also put into the bank account. So we add 2,500 into our bank account. So if we look into our balances, it says bank overdraft. You must remember that bank overdraft is a negative figure. So when we add 1,800, we do minus 2,580 plus 1,800. and that still gives us negative 180 and is a bank overdraft. Fifth adjustment. A bad debt of 240 was to be written off at 31st March 2003. A bad debt is any money a trade receivable owes you that we think is never going to be received again. So what we do is subtract 240 from trade receivables and also put 240 as an expense, so bad debt 240 separately. Sixth adjustment. Wages and salaries of 830 for the week ended 31st March 2003 have not yet to be paid. So let me just remind you again, we include everything that we should have paid, not what we have paid. So 830 we should have paid. So we add 830 to wages and salaries, as well as that 830 is an accrual expense. So accrual expense is a separate balance. So our new wages and salaries balance is 38,090. Alright, so we've finished the second step as well. Now we have to transfer all our figures. I won't be talking through the transformation of the figures, but I'll fast forward it so you don't have to wait so much. Okay, since we finished transferring our figures, it's time to calculate them. So as always, we start with our income statement first. So we do sales minus sales return, and that gives us 153,930. Now we do cost of sales, which is in opening inventory, plus purchases, minus purchase return, but we don't have any purchase returns, plus carriage inwards, minus closing inventory, and this gives us 75,480. And then the way we work out gross profit is net sales minus cost of sales, and that gives us a total of 78,450. For other income, we only have discount received, which is 790, so that's our total income. And then for expenses, we add up all our expenses: discount allowed, general expenses, heating and lighting, rent and rates, wages and salaries, depreciation expense, irrecoverable debt. This gives us a total expenses of 68,590. And then to work out our profit or loss of the year, we do gross profit plus other income minus total expenses, and that gives us 10,650. So what we do now, we transfer the profit of the year figure into our statement of financial position in the finance by section. And then we start from the top again. For non-current assets, we only have shop fittings, which is 7,160. And then we have current assets, which is inventory plus trade receivables plus prepaid expenses. This gives us a total of 34,930. Current liabilities, we have trade payables plus accrual expense plus the bank overdraft, and this gives us a figure of 7,130. And then to work out the net current assets, we do total current assets minus total current liabilities, and this gives us 27,800. And then for our non-current liabilities, we only have bank loan, which is 7,600. And then for net assets, we do our total non-current assets plus our net current assets minus our non-current liabilities, and this gives us 27,360. And then we go into our finance by section, which is opening capital plus profit of the year minus drawings, and this gives us 27,360. We know our answer is correct because we've got the same closing capital as our net assets. Anyway, this is the end of the video. If you have any questions, please comment down below. I'll try to reply as soon as possible. Thank you once again. Make sure you like and subscribe.